Hello there, I'm Erin Aid. This is Boom Bust, and these are some of the stories that we're tracking for you today. Scottish voters headed to the polling booths on Thursday to choose whether to remain a part of the UK or to secede. RT correspondent Polly Boyko is bringing us the latest from the ground in Edinburgh. And we're bringing you part two of my interview with Dr. Ron Paul. The former congressman sat down with me to discuss the state of the U.S. economy today. Then in today's big deal, Edward Harris and I are talking Fed. It all starts right now. Scottish voters headed for the polling booths on Thursday to choose whether to remain part of the United Kingdom or to secede. If the Yes campaign seeking independence for Scotland secures a majority, it will usher in the most dramatic constitutional change in Britain since the two countries united way back in 1707. Now, I was joined earlier by RT correspondent Polly Boyko, who is in Edinburgh to cover the referendum vote, and I first asked her what the current mood is in Scotland. Here's what she had to say.
Well, it's absolutely electrifying. We are in Edinburgh and we've seen people streaming in and out of the polling stations all day long. It's a bit of a family affair because a lot of the polling stations are in schools, so people are going with their children to vote, even if they're sort of not old enough to vote themselves yet. And a lot of people talking about how historic and momentous an occasion this really is. We've had sort of campaign materials, people were canvassing up until the very last minute last night, trying to win those undecided voters over. It's said that there's still some 350,000 people who woke up this morning who just didn't know which way they were going to vote. And it looks like this referendum is going to be won by such a narrow margin that those 8% could be very important in the end.
Absolutely. And you know, this issue isn't going away. Yesterday, in fact, our studio guest told us when Quebec voted no in 1980, the secession movement was still big, and they got a second vote in 1995. So do you get the sense that the secession movement is here to stay?
I definitely think that the genie is out of the bottle because people here have sort of been, I don't know how to say it, infected by this sort of referendum independence fever. And I think the difficulty with a win with what's likely to be a very narrow margin either way is that somebody is bound to be, or a big chunk of the population is bound to be very disappointed with the result. And if it's the Yes camp, then they're going to keep pushing for greater powers and they're going to try and get the best possible deal from Westminster for maximum devolution. But as I said, yes, when it's such a narrow margin, it's very difficult to see how the country, the United Kingdom and Scotland within itself is going to go ahead, really. That's the problem with winning this with such a narrow margin, that such a big chunk of the population might be disappointed with the result. And already there are people talking about trying to bring people together after the winner is announced. I spoke to a woman just today who told me that her daughter's school homework for these next 3 days is to write out 3 good things about the union and 3 good things about independence, trying to get people to see the positives in both, because nobody knows what the result is going to be.
That's very interesting to hear. Now, I also want to ask you, what are people saying about RBS and Lloyds Bank leaving Scotland? Do they care at all? Is this a good thing or a bad thing? What's the tone?
Well, it's quite simple. People who support the independence movement, they think that this is scaremongering, that it's intimidation tactics by Westminster. People that support the No movement and who want the union to stay together think that these are very credible concerns, that there are worries about what will happen to the economy, that the promises made by Alex Salmond, the leader of the Scottish National Party, the leader of the pro-independence movement, that he's promising really everything and nothing at the same time, because there's so much uncertainty. It all depends on what would be negotiated after the poll is closed and the winner is announced, if it's a yes vote. So again, it depends on which side of the fence you're on.
That was RT correspondent Polly Boyko reporting from Edinburgh, Scotland. Now, to explore the issues surrounding mortgage finance in the U.S. financial system, I was joined in studio by Arnold Kling, blogger at AskBlog and adjunct scholar at the Cato Institute. In this segment, I first asked him if the U.S. should phase out the interest deduction subsidy. Here's what he had to say.
A good idea for a robust financial system is one where firms don't have the incentive to take on more debt relative to equity. And so when you make interest payments tax deductible, you're saying to firms, you know, it'll be cheaper and you'll have a higher return on equity if you take on more debt. And if you take away that subsidy, then you take away that incentive to take on more debt, and I think you get a more robust financial system.
Now, Arnold, let me read you a quote from the comments from the Financial Times website that I thought were pretty interesting here. So, since the rise of capital markets centuries ago, it was understood that the creditor had a responsibility to investigate the credit worthiness of the borrower because the creditor bears the risk of default. The idea that a creditor can make a reckless loan without diligence and then stand behind the sanctity of contracts weakens the entire credit and capital allocation concept underlying capital markets. When a contractual promise to pay can be adjusted according to predefined process, then balance is restored to the risk-reward calculation behind capital allocation. If the lender is going to bear more risk, then rewards should be commensurately increased. So what do you think about the logic here?
That, if I read that right, they sound like they don't believe that the originate-to-distribute model can work at all.
Right.
In fact, it can work. It takes a lot of effort. At Freddie Mac, we had probably somewhere around a fifth to a quarter of the organization doing what they called risk management, which was doing investigating how the originators were originating their loans, often literally going on site to audit how they were producing loans, and if the audit showed that the people were incompetent or they weren't making the decisions according to Freddie Mac guidelines, then the seller, then that originator could be penalized.
Okay.
So it can work, but it does require putting processes in place to manage what economists call the principal agent problem. That is, these are people are acting as your agent, and you want them to act the way you would if you were doing their job.
Do you think that intrinsically won't work, though? You want them to act a certain way?
No, I think it can work. I do think overall it's probably more expensive and complex than having the employees report directly to you, where you can do your own training,
right.
You can fire them right away, and so on. So I think it probably is somewhat more expensive to outsource it, but it's not totally unworkable.
Okay. Now, I understand that the FBI warned in 2004 about an epidemic in fraud in the mortgage arena, and you seem to agree with them. I actually want to read a quote from you back in 2009. You wrote, "A program of reduced documentation becomes a magnet for fraud. Under such programs, swindlers operating as mortgage originators can concoct remarkable schemes to sell mortgage loans and abscond with millions of dollars. The GSEs experienced this sort of fraud in the late 1980s, and that is why in 1990, when a trend towards reduced documentation of mortgage loans was building, Freddie Mac and Fannie Mae issued a joint policy against purchasing low-doc loans for a time. This put a halt to the trend." So what did you mean by that?
In the originate-to-distribute model, there is an incentive for an originator to commit fraud. And so you have to put processes in place to try to prevent it. One of the processes is requiring documentation that most borrowers complain is unnecessary and too time-consuming, so documentation of their income and their assets and so on.
It seems pretty reasonable, though.
Not only is it reasonable, but if you take that away, then it's like you're holding up your hand and saying, if you're interested in fraud, come to me because I have the least, I make the least effort to check on the borrower.
Right.
So So that's why Freddie and Fannie stopped doing it. And then market pressures came, and again, by 2003, 2004, they're losing market share. And so one of the ways they try to get market share back is to open the door to these low doc loans again, which again invites outright fraud, as well as just lots of loans that really, even though they're not fraud, are not likely to be repaid unless house prices keep going up.
Right, the low doc loans. It's exactly what you say. There's not a lot of documentation there. Now, you wrote an article with a group of distinguished economists in 2012 on reforming America's basically finance system as a whole. So what were the highlights from that piece?
Okay, well, we were focused on the mortgage finance system, and we actually had each person writing the piece there had their own proposal, and I had two. So there were 6 proposals from 5 authors. One proposal was just to restore Freddie Mac and Fannie Mae the way they were, with more rigid capital requirements and very strict rules on what kinds of loans they could buy. So they could no longer work their way down into the high loan-to-value, low down payment lending, which was what got them in so much trouble in 2006, 2007. And the other approach was just to sort of back off from securitization altogether and let the market come to terms with it. And my guess is that it would revert to something like a model where the originate and hold model, where the banks would originate the loans and hold them. But I think the most important thing, rather than thinking about who finances the loans and whether it's originate to distribute, originate and hold, the most important thing is for the government not to encourage low down payment lending. It really does no one any good. It creates a speculative market for housing where people are, you know, if they're only putting 1 or 2% down, if the price goes up, they win. If the price goes down, somebody loses.
Right.
And I think what we should be encouraging is home ownership, not home speculating.
That was Arnold Kling, blogger at AskBlog and adjunct scholar at the Cato Institute. Time now for a very quick break, but stick around because when we return, Dr. Ron Paul will be on the program. The former U.S. congressman sat down with me to discuss the state of the U.S. economy today, and you definitely don't want to miss what he has to say. Then in today's Big Deal, Edward Harrison and I are talking Fed. And remember, you can see all segments featured in today's show on YouTube at youtube.com/boombustrt and on Hulu at hulu.com/boom-bust. And now, as we go to break, here are a look at some of your closing numbers at the bell today. Come on back with us.
What are your thoughts on what's been going on in Washington?
Well, it's a mess, Larry. I mean, the whole country is being scoffed at and laughed at.
Enough is enough.
The media, the candidates, the corporatocracy, covering issues that actually affect you and me doesn't do too much for ad revenue.
Biotech agriculture giant takes on a 76-year-old American farmer based in Indiana.
How much fallout do you think this is going to create for the CIA?
Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
Breaking the set is mostly about alternatives to the status quo, but one that gave real alternatives a voice.
One minute they were working toward the American dream, the next they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
I'm the resident, and I know words are powerful. Words like cheap, as in people who buy the crap our media sells us are acting like a bunch of sheep. Or words like greedy, as in our entire financial system is rigged by a bunch of greedy jerks. Or words like consumers, as in there's more to life than just being gluttonous consumers. I'm the resident, and I'm fighting idiocy one carefully chosen word at a time.
Welcome back to the show. Now, joining us live from our Los Angeles studio is RT correspondent Lindsay France. Now, in addition to releasing their best iPhone to date, Apple announced on Wednesday that they want to make it impossible for law enforcement to demand data from their customers, and that's even with a search warrant. So now, Lindsay, we go to you. I want to first start off by asking you, is this even possible? And do you think Apple will be successful in preventing law enforcement agencies from getting user data?
Well, Aaron, let's keep something in mind here. The U.S. government may have a lot of weight to throw around legally, but Apple and companies just like it have got teams and teams of lawyers, very talented at what they do, and they have not entered into this blindly. Now, this is the new privacy policy, of course, connected with Apple's new iOS 8 mobile operating system. And the language in this privacy policy essentially says that Apple does not have the ability to crack into information such as emails, photos, recordings, etc., and hand them over to police even when a search warrant is given. So essentially, it's taken engineering and implemented that to give the user the autonomy that the user wants. Now, it even says on its website, in a very tongue-in-cheek way, unlike our competitors, Apple can't bypass your passcode and therefore cannot access this data. So it's technically feasible, not technically feasible, for us to respond to government warnings for the extractions of this data from devices in their possession running iOS 8. Now, this could just do the job if their lawyers can make this stick. And of course, here's another great thing for Apple is that this only covers iOS 8. So any devices that cannot download iOS 8 are pretty soon not going to as strongly guard your privacy, which means you better upgrade. Cha-ching.
Lindsay, what about the cloud and other Apple products? How will Apple protect user data there?
Well, this is where Apple is distinguishing itself with a different approach. So this privacy policy only covers iOS 8. Things in the cloud that are pushed to the cloud automatically from your device are not as covered. So that we're talking about photos, video, email communications, music collections, recordings, all of that stuff. So if you want to block that from a warranted search, you've got to shut off that data flow. Now, this could change due to an engineering adjustment in the future. I mean, who knows? But on the heels of this, celebrity nude photo hack that just went on very recently, Apple has got a very fine line to walk with regard to the public. So it has just launched a new website that is basically spells out its privacy policy to the public. And it takes a swipe at its competitors, showing that it does have really good privacy policies in place. And it plans to update those on that website as time goes on. So this is a big change for Apple, and we'll see if any more are coming using engineering to guard your privacy.
Absolutely. Thank you, Lindsay. That was RT correspondent Lindsay France from our LA studio. Dr. Ron Paul, former U.S. congressman and three-time presidential candidate, is a well-known advocate for free markets and non-interventionism. Now, I had the chance to sit down with him to get his take on a number of issues, including the state of the U.S. economy. I first asked Paul if the Fed should start raising rates since we're finally seeing signs of real job recovery. Here's what he had to say.
I think the Fed should not deal with rates. They shouldn't raise them. They shouldn't lower them. They should just get out of the way and let the market set the rates. Because many people have argued that we got into this trouble because Bernanke, or Greenspan actually, kept rates too low too long. And then when the individuals got in to correct it, they lowered them even lower. Now, if you're interested in a market economy, one of the worst things you can do is rig and regulate interest rates. It's price fixing, and the interest rates are one half of the economy because it manipulates the value of the currency. So I would say that you don't know what is best. My assumption would be that zero is pretty low, and that if you allowed the market to enter into the picture, rates would be higher, and we wouldn't be punishing the savers. Free market rewards people who save and be responsible, pay their bills, and take care of themselves. But under the circumstances where you make rates zero or minus, nobody wants to do that, and this destroys the whole market process.
Dr. Paul, the Fed says it's worried about deflation, but you seem to be worried about the destruction of the dollar. So can you tell me why the Fed's deflation fears are misplaced?
Well, because they have a different definition than free market economists have. We believe that inflation is when you have a monopoly control over a fiat currency, the paper money, and you increase it excessively, and that's inflating the currency, and by common sense it tells you it lowers the value of the currency. And there's been no deflation. I mean, if you look at QEs and look at what's happened since the recession of '08, I mean, they've quadrupled or more of the monetary base. It's just that people don't want to use it because they have no confidence, but the money is out there and the distortions are still felt. You still have excessive debt. You still do have even price inflation they won't admit to. The price of a bond is sky high. The price of the stock market is sky high once again. Housing prices are soaring in many parts of the country. And then for them to say there's no inflation, talk to people who have to pay for a college education or for medical care. There's a lot of price inflation, but there's a lot of monetary inflation. And that means there's a lot of distortion, a lot of malinvestment, and excessive debt, and we have not done anything to correct the fundamental flaws that gave us the Great Recession.
Now, the Swiss are going to vote in November whether to prohibit gold sales and mandate that assets be backed at least by 20% gold. So what do you make of these measures?
Well, I think this is great. I think that's the people waking up. Switzerland used to have a really great reputation for banking as well as sound money. So now they want to repatriate their gold. They don't want any more gold sold, and they want their currency backed by 20%. This is very, very good, and they're letting the people speak out. I just hope the people have not been brainwashed enough to thinking that this is a bad move. I think it's a wonderful move. And of course, openness in banking is something I've argued here, and they continue, even though I am not in Washington, they've continued with the idea that we should audit the Fed and know what's going on in central banking. So this is a challenge to the central bank and the whole monetary system. So I'm watching that referendum very closely.
The Swiss National Bank has actually intervened to keep the currency from appreciating because it was harming exporters. So was this good policy or folly, in your opinion?
Well, on the short run, I guess they've argued this for years, and we do it all the time. We issue a currency, which is the reserve currency. We keep our interest rates very, very low. But for other reasons, the fact that we're still a wealthy country and we have a wealthy and a huge military, you know, the dollar holds up reasonably well. But no, we challenge the others. We challenge China and others for not allowing their currencies to float. But we don't. We rig it. And it also, we get this special benefit that we can run a trade and a deficit with the foreigners. So we are the greatest debtor nation in the history of the world. It seems like we're getting away with it, but what I'm saying is we're not going to get away with it forever. There's going to be a price to pay for us doing that.
Now, back to the U.S., let's return. So what should we do about all of the debt that households have been allowed to build up, especially if the real burden of that debt increases the deflationary recession? I mean, should we force banks to write down all this stuff?
Well, we should just get out of the way. When it gets out of whack, and Adam Smith even talked about this, when governments especially get a debt at a certain level, it's never paid. It's never paid for by the people working harder and paying more taxes and you pay down the debt. They just resort to studying Keynesian economics that says deficits are good, they're not bad. Borrow money, spend money, and that's just what makes the economy percolate. But I don't believe that that is true. And I think debt is...
That was former U.S. Congressman Dr. Ron Paul. Time now for today's Big Deal. Big Deal time with Edward Harrison, and today we're talking Fed, because we haven't talked about it in a while. It's good to have an eclectic mix here. Now, the Fed is almost at the end of its asset purchase program, and it is poised to raise rates next year. Now, Ed, everyone believes this, so why are we surprised by what happened at the FOMC meeting this week?
I think the interesting bit about this particular Fed meeting is the dichotomy between what they're saying they're going to do or what they expect to happen with rates and what they're saying about their projections for the economy going forward. So on the one hand, when you take a look at, they released these projections of where rates are going to be in 2015, 2016, and 2017 now for the first time came out. And all those numbers are higher than they were the last time the Fed met. So basically what they're saying is we are going to raise rates much faster than we said the last time that we met. So that's number one. You would think then number two, which is what the real economy is doing, would be in line with that. But what they've shown is that their economic projections are going down. They don't see the economy doing as well as they had projected before.
Right. Now, we know that the Fed is downgrading forecasts, but they keep, pushing these rate hikes forward and forward. So what's up with that? What does that mean in a more macro scheme?
So I think what the problem that they have is that when you have the Fed acting, it's really just acting through the credit cycle. It's not helping you and me. It's not like the Fed is pushing up our wages so we can go out and buy more stuff.
Sure isn't.
They're just making borrowing money cheaper so you can add on more debt. And the problem with that is that it actually increases asset prices, and that's really the effect that it has. And ultimately what that means is that the recovery that we've seen has been a lopsided recovery. So asset prices are going up and they want to work against it because they're going up too high, but at the same time the real economy kind of is mediocre. And so how do they deal with that? They deal with that by doing exactly what we're seeing right now.
And Ed, we're now 6 years into this zero-rate policy regime. So the big question is, has this been successful? What do you think?
I think it's not successful in any way, shape, or form. What it shows you is that printing money, relying completely and only on the Federal Reserve and a monetary policy is a recipe for disaster. I mean, this is exactly what the United States has done actually for the last quarter century. We had rates at ridiculously high levels after the inflation of the 70s, but each time that we had a recession, we brought rates down, relied on the Fed to bail us out, and now rates are at 0%. There's nowhere to go, and unless the Fed raises rates now, they won't be in a position to be able to lower them later on. Imagine if we reach a recession in 2015, 2016, rates are at 0%. What's the Fed going to do then?
I don't know. They'd have to go into negative territory.
Exactly, and that's exactly where the ECB is.
So what do you, yes, exactly. So we'll just be doing what Europe's doing, which is not what we want to do. So, what do you expect to actually happen going forward? If you were a betting man, what would you say?
Well, I would say that what's going to happen is that they definitely will finish QE off this year, and then they'll see how the economy is. If the economy holds together decently well, which I think it will, they will hike the rates as they said they have, and that rates will go up in Q2 of 2015. But the economy is soft enough that it's not going to be a very pretty picture.
Ed, as always, thank you, and we'll be standing by, checking out what happens in 2015 early. That's all from now, but we love hearing from you, so please check out our Facebook page, facebook.com/BoomBustRT, and we also love hearing from you on Twitter, so please tweet at us at Aaron8, at EdwardNH. From all of us here, thank you for watching. We'll see you next time. Bye-bye.